Back to the explainer. Today, we're diving into a real-world crypto investment blueprint that is, quite frankly, fascinating. If you've ever found yourself wondering how systematic investors tackle super volatile, speculative markets without, totally losing their minds, you're exactly in the right spot. We're going to deconstruct one specific investor's methodology for accumulating a relatively new crypto asset. It's a really compelling look at the intersection of high-risk ambition and strictly regimented risk management.
All right, let's get right into it. Here's our roadmap for today. We're looking at the Linea accumulation strategy, how to protect capital through diversification, a breakdown of a 2026 to 2027 crypto portfolio, the tactics of buying during market declines, and finally, the profit-taking exit plan. So the subject of our case study today is a strategy laid out by a YouTube channel called TheAbrahamCryptoLand. And what really makes this stand out for our explainer is their intense focus on what they call the investor's mindset. Instead of just hyping up coins with a bunch of crazy emotion, this creator publicly logs a really meticulous, pre-planned journey of accumulating a specific, newer crypto called Linea. They're literally putting it all out there, their rules, allocations, price targets for everyone to see. But to really grasp this strategy, we've got to understand the psychology behind it. Look at this quote from the creator. Every long-term investor understands that market declines are a natural part of charts and a normal part of investing. That's a huge mindset shift, right? Where most people see red charts and just absolutely panic, this investor sees drops not as a disaster, but as totally normal, expected events in a long-term cycle. Honestly, that emotional detachment is the engine running this whole blueprint. Part 1. The Linea accumulation strategy. So, why Linea? Out of the thousands of cryptos out there, why is this investor aggressively targeting this specific one? Well, as they point out, Linea is pretty new. But the real driver here is the fundamental belief that it's backed by powerful companies. Now, they're the first to admit nobody has a crystal ball for this specific coin, but because it has that strong corporate backing, it represents this highly calculated opportunity that they firmly believe is worth tracking closely. And that brings us to the massive upside they're hoping for. This creator isn't in this for some safe, boring 5% annual yield. They are hunting for exponential growth. We're talking calculated potential returns of 10x, 20x, 50x, maybe even 100x gain on their investment. This perfectly captures the high-risk, high-reward nature of this asset within their broader financial plan. But obviously, chasing a 100x return usually carries the very real risk of that asset plummeting straight to zero.
Which brings us to part 2. Protecting capital through diversification.
And here is the ultimate defense mechanism, a strict 5% cap. This creator absolutely refuses to dump all their capital into one project, even one like Linea. No matter how promising it looks or how crazy that 100x potential is, the allocation is strictly, stubbornly capped at just 5% of their total crypto capital. This is literally the cornerstone of their risk management. Think about it. If Linea fails completely, 95% of their portfolio is totally intact. They're taking a moonshot for sure, but they are absolutely refusing to bet the farm to do it. Moving on to part 3, the 2026 to 2027 crypto portfolio.
So if Linea is only taking up 5%, where's the rest of the money going?
Well, here's how that remaining 95% is deployed to stabilize things over the next few years. Notice how the heavyweights totally dominate here. You've got Bitcoin at a massive 40% and Ethereum holding 20%. That means a full 60% of this portfolio is locked into the two most established, historically resilient assets in the crypto space. Then we've got XRP and Bitcoin Cash sitting at 10% each. It's only down at the very bottom that we see these smaller, riskier 5% slices. Solana, BitTensor, Aster, and of course, our case study Linea. Really, this breakdown is just a masterclass in hedging your bets. Just to summarize the whole philosophy here, the overarching goal is to spread risk across multiple projects while fiercely maintaining a strong allocation in those established assets. You can think of that 60% in Bitcoin and Ethereum as a heavy anchor keeping the ship from capsizing, while those tiny 5% allocations like Linea are the sails, meant to catch the wind and hopefully give you that massive, outsized acceleration. It's a really deliberate balancing act between preserving wealth and actually generating it. All right, part 4, buying during market declines. Now, take a look at the downward momentum on this chart provided by the creator. While the asset is clearly losing a lot of value, you'll see arrows pointing straight down into the crash, which actually indicates active, strategic accumulation. Literally, as the price is falling, this investor is actively stepping in to buy. And this is such a stark contrast to how people usually react in the markets. I mean, the average reaction to an asset losing value is just pure panic selling, right? People want to cut their losses and run away from the pain. But this blueprint, it demands a totally different, highly disciplined reality, methodically buying during those exact price drops. And because they're shielded by that strict 5% cap we talked about, they're not terrified of the red candles. They are treating this decline as a pure buying opportunity to build up their position for the future.
What's really cool is the creator doesn't just talk about doing this. They document the entire, and let's be honest, probably painful process of buying the dip. They actually have these comprehensive, dedicated YouTube playlists for their community with titles like Linea Crypto Investment Strategy, Complete Journey. So you can basically look over their shoulder and watch this accumulation happen in real time. It completely removes that smoke and mirrors vibe you usually get with online investing claims.
Finally, part 5, the profit-taking exit plan.
Okay, this whole strategy hinges on highly specific, predetermined triggers. And for Linea, the magic number is exactly 000356. The investor isn't just going to wait to see how they feel on a given Tuesday to decide if they should sell. No, they calculated this exact target price well in advance. The second the market hits this specific fraction of a penny, the profit allocation exit strategy automatically kicks into gear. Let's break down how this forms a totally actionable, emotionless sequence. Step 1. Continue methodically building in the Linea position while prices are low. Step 2. Patiently wait for the price to hit that precise 0.00356 target. And step 3. Sell exactly 10% of that accumulated position at a profit. Notice, they aren't dumping the whole bag. They're just skimming 10% off the top to lock in real tangible gains, recovering capital, while leaving the remaining 90% wide open to potentially catch those crazy 50x or 100x moonshot returns later on. It is incredibly methodical.
As we wrap up this explainer, I want to leave you with a final, provocative thought that really challenges standard investment psychology. Does the lure of 100x potential returns outweigh the rigid discipline required to cap your risk at exactly 5%? This case study is a perfect reminder that successful investing isn't always about picking the perfect asset. It's about building a psychological fortress around your capital so you can actually survive the volatility long enough to see your thesis play out. Thanks for hanging out with me today.